In September of 2008, the global financial system collapsed, and 13 million Americans lost their homes, and 8.7 million lost their jobs, and $17 trillion in household wealth vanished, and the world economy nearly ended. And it was not an accident, and it was not a natural disaster, and it was not unpredictable because the banks knew exactly what they were doing, and they did it anyway because they knew they would be saved, and they were right. This is the story of the greatest theft in human history, and how the people who caused it were rewarded, and how you paid for it, and how it could happen again. Welcome to Paper Empires, where fortunes are built on lies. The dream. Let us go back to the beginning to understand how this happened. For decades, owning a home in America was the dream, and it was achievable because banks were careful about who they lent to, and mortgages were boring and safe. And if you had a job and a down payment and decent credit, you could buy a house and pay it off over 30 years and build wealth. This system worked for generations because everyone had skin in the game, and the banks kept the mortgages they issued, so if you defaulted, they lost money, which meant they only lent to people who could actually pay them back. But in the 1990s, something changed, and Wall Street figured out they could turn mortgages into a product and sell them to investors, and this changed everything. Because suddenly the bank that gave you the mortgage did not care if you could pay it back, because they were not keeping it. They were selling it. This is called a securitization. And it sounds boring and technical, but it is the key to understanding how the entire world economy collapsed. Because once banks could sell your mortgage to someone else, they stopped caring about risk and they started caring about volume. The more mortgages they issued, the more money they made. And it did not matter if you could afford the loan because that was someone else's problem now. Think about that for a moment. The person lending you hundreds of thousands of dollars has zero incentive to make sure you can pay it back because they are going to sell your debt to someone else before your first payment is due. This is not banking anymore. This is a scam dressed up as finance. The product. So Wall Street took these mortgages and bundled them together into something called mortgage-backed securities and sold them to investors around the world. And these investors, pension funds and banks and governments, were told these were safe investments backed by real assets, which were the homes. But Wall Street did not stop there because they created something even more complex called collateralized debt obligations, or CDOS, and these were bundles of mortgage-backed securities mixed together and sliced into different levels of risk. The logic was simple. Even if some mortgages default, most will not, so if you bundle enough of them together and spread the risk, the investment is safe. Except it was not safe because the mortgages being bundled were garbage, and everyone knew it, but no one cared, because everyone was making money. The banks made money issuing the mortgages, and Wall Street made money packaging them, and the ratings agencies made money giving them perfect scores, and the investors made money buying them. And as long as housing prices kept going up, everyone won. But housing prices do not go up forever. Here's where it gets truly insane. Wall Street started running out of good mortgages to bundle, so they told the banks to lower their standards and issue more loans to more people regardless of whether they could afford them. These were called subprime mortgages, and they were given to people with bad credit and no income verification, and no down payment, and sometimes no job at all. These were not mistakes. These were features of the system because Wall Street needed more mortgages to feed the machine, and the banks were happy to comply because they were making billions. There were ninja loans, which stood for no income, no job or assets, and there were adjustable rate mortgages with teaser rates that would explode after 2 years, and there were interest-only loans where you never paid down the principal. People were told they could refinance before the rates went up, or sell the house for a profit because prices always go up, except prices do not always go up. The ratings. Now here's the criminal part. None of this would have worked without the credit rating agencies. There are 3 main agencies that rate the safety of investments: Moody's Standard and Poor's and Fitch, and their job is to tell investors whether something is safe to buy, and a AAA rating means it is as safe as a government bond. These agencies gave AAA ratings to mortgage-backed securities and CDOs that were filled with subprime garbage, and they knew the mortgages were bad, and they knew the borrowers could not pay, and they gave them perfect ratings anyway. Why? Because the banks creating the securities paid the ratings agencies to rate them, and if one agency refused to give a good rating, the bank would just go to a different agency. This is like a student paying the teacher for an A, and if the teacher refuses the student, just finds a different teacher who will. And the entire education system is based on this corruption. The ratings agencies made billions of dollars rubber stamping toxic assets as safe investments, and pension funds and retirement accounts around the world bought them because they trusted the ratings. In 2007, 93% of all mortgage-backed securities rated AAA were later downgraded to junk, and some of them lost 100% of their value, but by then it was too late because the damage was done. The ratings agencies faced no consequences because their ratings are protected as free speech under the First Amendment, which means they can lie about the safety of investments and claim it is just an opinion. Think about that. They destroyed the global economy with fraudulent ratings, and their defense was that their opinions are protected speech. The bets. But it gets worse because Wall Street was not just selling these toxic assets, they were betting against them. They created something called credit default swaps, which are essentially insurance policies on mortgage-backed securities, and if the securities failed, the person holding the swap would get paid. Here's the genius and the evil. The banks packaging and selling the toxic mortgages knew they were toxic, so they bought credit default swaps betting that their own products would fail. This is like a car manufacturer selling you a car they know will explode and then taking out a life insurance policy on you and collecting when you die. Goldman Sachs famously sold mortgage-backed securities to their clients while simultaneously betting against those same securities with credit default swaps. And when the securities collapsed, Goldman made billions while their clients lost everything. This was not a conflict of interest. This was fraud. And they did it openly because they knew no one would stop them. And the most insane part, you did not even need to own the mortgage-backed security to buy a credit default swap on it, which meant people were making bets on assets they did not own, creating a casino where the bets were worth more than the actual houses. AIG, the insurance giant, sold tens of billions of dollars in credit default swaps without having the money to pay them if the mortgages failed, because they assumed the mortgages would not fail because they had AAA ratings. When the mortgages did fail, AIG could not pay, and the entire company collapsed, and the US government had to bail them out with $182 billion of taxpayer money. AIG did not destroy the economy because they were unlucky. They destroyed it because they were greedy and reckless, and they thought they were too big to fail. And they were right. The collapse. By 2006, housing prices stopped rising, and people with subprime mortgages started defaulting because their adjustable rates reset, and their payments doubled or tripled, and they could not refinance because their homes were now worth less than they owed. Foreclosures started slowly, then accelerated, and as more homes flooded, the market prices dropped further, which caused more defaults, which caused more foreclosures in a death spiral. The mortgage-backed securities backed by these failing loans started losing value, and the banks holding them started panicking because suddenly the assets on their balance sheets were worthless. In March 2008, Bear Stearns, one of the largest investment banks, collapsed and was sold to JP Morgan for $2 a share, and the Federal Reserve guaranteed $30 billion of Bear Stearns' toxic assets to make the deal happen. This should have been the warning, but instead everyone pretended it was contained and that the worst was over. It was not over. It was just beginning. In September 2008, Lehman Brothers collapsed, and this time the government let it fail. And this was the moment the world realized the entire financial system was built on fraud. Lehman had $600 billion in assets, and when it filed for bankruptcy, it triggered a global panic. Because if Lehman could fail, any bank could fail, and suddenly no one trusted anyone. Banks stopped lending to each other because they did not know who was holding toxic assets, and the credit markets froze, and businesses could not get loans, and people could not get mortgages, and the entire economy ground to a halt. The stock market crashed, and retirement accounts vanished, and companies laid off millions of workers, and the unemployment rate doubled, and the world stood on the edge of another Great Depression. And the banks that caused this? They went to the government and said, if you do not save us, the entire economy will collapse. And the government believed them. The Bailout. In October 2008, the US government passed the Troubled Asset Relief Program, or TARP, which gave $700 billion to the banks that caused the crisis. $700 billion of taxpayer money to save the banks that destroyed the economy through fraud and recklessness and greed. The logic was that these banks were too big to fail, and if they collapsed, they would take the entire economy with them, so the government had no choice but to bail them out. But here is what actually happened. The banks got the money, and instead of using it to help homeowners or restart lending, they used it to pay bonuses to the executives who caused the crisis. In 2009, while 13 million Americans were losing their homes, Wall Street paid itself $20 billion in bonuses. The government could have used that $700 billion to help homeowners by reducing their mortgage principals or refinancing their loans at lower rates, but they chose to save the banks instead. The government could have nationalized the failing banks and fired the executives and restructured them and sold them back to the public. But they chose to save the executives instead. The government could have sent bankers to prison for fraud because there was fraud everywhere in the ratings, in the lending, in the securities, in the betting, but they chose to prosecute no one. Not one major Wall Street executive went to jail for causing the 2008 financial crisis, not one. Compare that to the savings and loan crisis in the 1980s, when over 1,000 bankers were prosecuted and many went to prison. In 2008, the crime was 1,000 times larger and the punishment was zero. Why? Because the banks own the government, and the politicians and the regulators in the system is designed to protect them, not you. The banks that were too big to fail in 2008 are now even bigger, and the executives who caused the crisis were rewarded, and the taxpayers who bailed them out got nothing. The victims. Let us talk about who actually paid for this, because it was not the banks. 13 million Americans lost their homes to foreclosure, and many of them had been lied to by predatory lenders who put them in loans they could not afford. 8.7 million people lost their jobs, and unemployment hit 10%. And for young people and minorities, it was much higher. $17 trillion in household wealth vanished as home values collapsed and retirement accounts evaporated. People who did nothing wrong, who saved and worked and followed the rules, lost everything, while the people who caused the crisis kept their jobs and their bonuses and their homes. This was not just an economic crisis, this was a transfer of wealth from the middle class to the banks, and it was deliberate. The psychological damage is harder to measure, but it is real because an entire generation learned that the system is rigged and that hard work does not matter, and that the rules do not apply to the rich. Millennials graduated into the worst job market since the Great Depression with record student debt and no opportunities, and they have never recovered. Home ownership rates for young people are at historic lows because they cannot afford down payments, and they do not trust the system, and they watched their parents lose everything in 2008. The 2008 crisis did not just destroy wealth, it destroyed faith in the system. And that faith has never been restored. The lesson ignored. After the crisis, the government passed the Dodd-Frank Act, which was supposed to regulate Wall Street and prevent another collapse. It was supposed to break up the big banks and create consumer protections and increase transparency and hold executives accountable. But Wall Street lobbied against it, and the law was watered down. And then Wall Street lobbied to repeal parts of it. And by 2018, most of the regulations had been gutted. The big banks are bigger than ever, and they are still too big to fail, and they are still making risky bets. And they still know the government will save them if they fail. The credit rating agencies still rate securities, and they still get paid by the banks creating them, and they still face no consequences for lying. The mortgage industry is back to issuing risky loans, and Wall Street is back to packaging them into securities and selling them to investors who do not understand the risk. The system that caused the 2008 crisis is still in place, and the people who profited from it are still in power. And when the next crisis comes, and it will come, they will do the same thing again because it worked last time. They will take insane risks because they keep the profits when they win, and you pay the losses when they fail. This is not capitalism, this is socialism for the rich and brutal capitalism for everyone else. The conclusion. Here is what the 2008 financial crisis teaches us. The system is not broken. The system is working exactly as designed. It is designed to extract wealth from ordinary people and transfer it to the banks. And when the banks destroy the economy through fraud and greed, the government saves them and sends you the bill. You were told the banks were too big to fail, but what they really meant is the banks are too powerful to prosecute. You were told the bailout was necessary to save the economy, but what they really meant is necessary to save the bankers. You were told the crisis was caused by irresponsible borrowers, but it was caused by criminal lenders and complicit regulators and a government owned by Wall Street. The 2008 financial crisis was not a failure of capitalism, it was capitalism working perfectly for the people who own it. And until we recognize that nothing will change because the next crisis is already being built. And the same people are building it, and they know they will be saved. Because in America, banks do not fail. Bankers do not go to jail, and you pay for everything. If this story opened your eyes, subscribe to Paper Empires. History has the answers, and we will show you where to look.